Hello, everyone, and welcome to episode number 89 of JustDario Cigar Time. As I'm recording this video, today is Friday, the 12th of June, during Asian hours. Today is going to be a historic day because SpaceX will start trading in New York at $135 a share in a few hours, with a $1.7 trillion valuation, raising more than $75 billion in capital. Truly an historic milestone. Same time, President Trump just declared for the 39th time, no kidding, that he is close to signing a peace deal with Iran. Signing this memorandum of understanding will officially start a 60-day negotiation period where the two parties commit to sign a final agreement by the end of it, in theory. However, isn't it quite hilarious that a few hours before President Trump declared this, he stated he would have attacked Iran for the third night in a row? Prior to that, Treasury Secretary Scott Bessent also put out a very big threatening post on X. He said any damage Iran inflicts on the GCC countries will be deducted from the eventual disbursement of funds they would receive. And then he told they receive as a payment to cross the Strait of Hormuz be deducted from those same funds. Every transaction they conclude in breach of sanctions will be deducted from eventual payments as well. Let's not forget, he's talking about Iranian funds being frozen in the banking system for a simple reason. They are in US dollar, not an outright payment from the US, war reparations, or something like that. If you put everything together and just sprinkle a little bit of common sense on top, not too much, you can easily draw a line. You will see how all these developments in the past hours clearly point toward the US administration steering things around to prop up markets and support the launch of the SpaceX IPO. That is all I have to say with regard to the most recent events in the past hours. The topic of today's podcast is gold and silver. Today, I'm going to explain to all of you why, even if both metals will remain weak in the short terms, on the contrary, because of the current economic and geopolitical situation, they are building up an incredible strength in the medium to long term. All stars are aligning in their favor. Before we begin, don't forget to like the video, subscribe to my channel, and turn on the notifications so you don't miss any of my future updates. Alright, let me start by explaining why a big buying opportunity for gold and silver is still ahead of us. One question that many people, and many of you, my dear followers, have been asking me lately is, why do gold and silver continue to remain so weak if we are in a war, inflation is so high, and the dollar has clearly been weakening significantly in the past months? The answer to this question is straightforward. Turkey, Indian, and retail investors. Turkey is currently falling into a deeper and deeper monetary crisis. The central bank, in order to slow down the loss of value of the Turkish lira, continues to sell its reserves in the market, especially gold. The past weeks, they ramped up selling gold certificates to the public and gold guaranteed bonds. Furthermore, there is another country that, as of late, is struggling from a monetary perspective. That country is India. The reason for the struggles is the increasing weakness in the Indian rupee because of increasing oil prices and the lack of strategic reserves the country holds to buffer it, and paradoxically, the high domestic demand for precious metals at the same time. As a consequence, the Indian central bank is bleeding gold reserves in two directions. One toward Indian public seeking refuge from a depreciating INR, and the second toward the open market because they have to sell reserves to fetch US dollar and pay for oil. This exacerbates the paradox where one of the most populated countries in the world, where gold is incredibly popular, as one of the lowest amount of gold reserves from a central bank perspective. There is another reason why gold and silver are suffering, and the reason is retail portfolio rotation. Retail investors in Asia, especially in Japan and Korea, were big buyers of gold and especially silver in the past months. And we know that both of these crowds are incredibly fickle, especially the Koreans. As a matter of fact, Koreans didn't blink twice before starting to dump their gold and silver when they began underperforming the stock market. Something that, of course, didn't happen in China, where the authorities maintain a very strict vigilance on any type of speculative behavior with irrational exuberance in the stock market. Chinese authorities always steer the public towards safer form of investment. Not surprisingly, in case you didn't know, the Chinese Market Authority banned the selling of SpaceX IPO shares to the Chinese public, both in the mainland and in Hong Kong. Putting all this together, you can understand how this type of flow is the one eventually dictating the move of gold and its reflection in silver, being greater in magnitude than the strong central banks buying for gold, especially by China, which notched another record in May. Despite still trading at a premium in China, silver is no longer in physical short supply for the immediate term. This can be easily observed by the shape of the silver futures curve across the markets, which is currently in contango. However, the imbalance of supply and demand paradoxically persists in the silver market, especially at an industrial level. The reason it trades at a premium in China, and this year will be the 6th year in a row that we will experience a supply shortage of roughly 150 million ounces of silver. And China factories remain the big industrial consumer of silver to make EVs, solar panel, electronics, semiconductors. But as you remember from many of the videos I did about silver, one way this shortage could be buffered in the short term was to entice retail investors and non-industrial holders to sell their physical metal into the market. This is effectively what happened. With the regulatory changes that happened in February, the Shanghai Stock Exchange effectively shut out retail buyers from the wholesale physical silver market in Shanghai, easing the squeeze. High enough prices that enticed a lot of holders to cash out some of the silver they had been stacking for many years and holding at much lower prices, along with the rug pull orchestrated by the comics on the 30th of January, did the rest. Beware though, this silver being sold by retail then enters the industrial cycle, and then it's gone. So the next time we get a situation of physical shortage, the buffer will be much smaller. It was smaller this last time compared with the previous silver physical squeeze that happened several years ago. To wrap up this first part of today's podcast, it's clear that gold and silver will suffer until the oil crisis finds an equilibrium and stabilizes. Until that moment, you can easily observe in the market that all these relief rallies are happening more because of speculative flow betting on the end of the oil crisis than because of all the other fundamental things I'm going to share with you. Next, because if the oil crisis is a drag on these two precious metals in the short term, paradoxically, it will be an incredible boost for both metals in the medium term. And that is what I'm about to talk to you in the second part of this podcast. In the medium term, the benefits of the oil crisis for gold and silver are straightforward. And here I'm talking about the physical metals themselves. What do you expect is going to happen due to the fact that energy prices are going to increase significantly? They will increase the mining costs of all the companies that are extracting gold and silver. Silver, let's not forget, is still right now a leftover of the mining process of other metals like copper, zinc, or tin. There are very few dedicated silver mines. The process of extracting silver, smelting it, and purifying it into 99.99% purity bars that are then useful for industrial purposes is incredibly energy intensive. A spike in energy costs will eventually reduce the capacity of gold and silver miners to extract commodities at the current pace. Especially for silver, when we are still at a supply deficit, this will tighten even more the physical supply available in the market. Miners will have to secure energy stockpiles with available cash. Then they will have to be able to sell their metals mined at a level high enough to cover their costs and margins. Eventually, for many months, whatever is physically available of gold and silver in the market is going to be whatever it is accessible. If you want to look for a historical precedent, just go back and see what happened in the 1970s after the oil crisis unfolded. Not before, not during, but after oil prices peaked. Gold and silver skyrocketed to the moon. One key driver was tight supply from mining. The reason, especially for gold, was inflation. And then Hunt brothers pulled that historic physical silver squeeze because, according to their calculation, they would have been able to corner the market due to the lack of new supply entering the system at that time. However, the Hunt brothers were not industrial users. They were trying to pull off a financial trade, so the silver wasn't disappearing and becoming unavailable, differently from what's happening today. Since they were trying to pull off the trade on debt, it was pretty straightforward to ultimately rug pull them to save the COMEX and the financial institutions caught on the wrong side of that transaction. But because of this, prices have been kept suppressed on silver for such a long time. We are in an incredible chronic deficit at the very moment when demand for silver at an industrial level to produce high efficiency electronics keeps growing. And that silver used in industrial applications cannot be easily recovered and recycled because you have very few grams of silver across many products, and that the current prices cannot support such an expensive endeavor. So before recycling becomes viable, the simple price needs to increase multiple times from where it is today. Eventually, the conditions that triggered the massive jumps in gold and silver prices after the first oil crisis are repeating themselves today, but from an even stronger base. In the medium term, the physical shortage of precious metals is going to play a massive role. Of course, the miners on one side might benefit from increasing prices because of their stocks in the ground. The other side, they might suffer on the margin front from an increase in energy costs. Similar to the 70s, energy costs are not going to come down, differently from what everyone believes today, making the same mistakes they did in the 70s. Then prices of gold and silver need to go up much higher to make the mining business profitable again. Here we go into the last part of today's podcast. What can happen to silver and gold in the long term? As I speak, many countries are already reporting inflation data around or above 4% year over year, with producer price inflation even above 6%. And as we know, producer price inflation precedes consumer price inflation. Eventually, companies can only support a temporary squeeze on their margins. If producer prices don't come down, they will eventually pass them on to the consumers. Consumers remain very strong because of the huge amount of credit, lending, central banks money printing, and loose monetary conditions being accommodated across the globe, especially in countries with very high debt, both private and public, like the United States. This week, I even stumbled upon a news that was shocking to me. Now, people in the US are having access to rent now, pay later types of loans. I mean, if you cannot even afford to pay rent, how will you be able to afford to repay the loan to pay rent on a property that eventually might already likely have a mortgage underneath it? You see how things are going completely nuts in the economies that are becoming a taller and taller house of cards of debt. Very similar to 2008, maybe way more. It's not a surprise that the purchasing power of fiat currencies in the real economy is crashing through the floor. And if you think that 4% or 5% interest rates will be enough to save fiat currencies, of course the answer is no. Because as we know, real inflation in the economy is much higher than that. Till rates sustainably remain higher than real inflation in the economy, for a very long period, in the same way Chairman Volcker made sure in the 80s to fight inflation, something that was very painful for financial markets but very badly needed at the time, monetary inflation and consumer inflation, will persist. However, in order to make sure the global financial system and government debt markets do not implode, central banks will have to continue to allow ample liquidity in the system to support the house of cards built piles upon piles of debt that the current global financial markets have become. And this is incredibly bullish for gold and silver in the long run. For a simple reason, because of monetary inflation. Anything that is in limited supply, sometimes even in short supply or in chronic supply deficits like silver, will eventually see its value grow exponentially in the long run, no matter what. It's just a mathematical calculation. At the denominator, you have the limited amount of ounces truly available in the market. Numerator, you have the total quantity of money that keeps increasing. Total M2 money supply just broke a new all-time high, by the way. Globally, above $22 trillion US this week, the M2 has reached. And if you disagree with anything I'm saying, feel free to drop a comment, and then let's discuss. To conclude today, I believe it's pretty clear what my personal positioning is right now. I will be very patient for the oil crisis to ultimately unfold and the price of oil to stabilize. That is still ahead of us, despite all the shenanigans that have been played to hide it. Potentially, it could start unraveling very soon because tank bottoms are surfacing around the world. They are starting to surface in the Middle East, where there are already tank bottoms being reported for the supply of ship fuel in the region. What a paradox! Even if the Strait of Hormuz reopened, the ship will not have enough fuel to live. And eventually, they might even struggle for those that want to venture inside to have the fuel to live afterwards. Wait for the oil crisis shock, similar to the 70s. And at that peak, I expect that it will mark the bottom for both gold and silver prices. That will be the moment to shut your nose, close your eyes, and not listen to the doomsayers who say precious metals are broken, they won't work anymore, or whatever. That will be the moment to jump back into the market and then sit tight for the ride ahead in the following years. This is what I plan to do myself. Fortunately, I cannot give you a price target for the short, medium, or long term because it's simply impossible to do so under the current circumstances. But the direction is very clear, and the future couldn't be brighter for both gold and silver. Thanks a lot for listening to my podcast again today, for supporting me on X, Instagram, and for reading my research on JustDario.com. I wish everyone a nice weekend. Bye.